A stop loss is a type of order used in trading to minimize losses when the market moves against a trader's position. It is an automated instruction that is sent to a broker or a trading platform to sell an asset at a predetermined price level. Once the asset's price reaches this level, the stop loss order will trigger an automatic sell order to close the position. A stop loss order is typically set at a price level below the current market price for a long position and above the current market price for a short position. Stop loss orders are essential because they can help to limit potential losses in volatile market conditions. When the market moves against a trader's position, a stop loss order can prevent the trader from losing more than they are willing to risk. Stop loss orders can be used for a variety of trading instruments, including stocks, futures, options, and currencies. For example, let's say an investor purchases a stock for $50 per share. The investor is willing to risk losing up to 10% of their investment, so they set a stop loss order at $45 per share. If the stock price falls to $45 per share, the stop loss order will trigger a sell order and the investor's position will be closed, limiting their loss to 10% of their investment. 3 benefits of using a stop loss. 1. Risk management. One of the main benefits of using a stop loss is that it helps manage risk. By setting a stop loss order, investors can limit their potential losses and protect their portfolio from significant declines in the market. 2. Emotion control. A stop loss order can also help avoid making emotional decisions. In a volatile market, it can be easy to get caught up in the moment and make decisions based on fear or greed. By setting a stop loss order, investors can take the emotion out of their decision-making process and stick to their trading plan. 3. Time management. A stop loss order can also save time. By setting a stop loss order, investors can avoid constantly monitoring the markets and their positions. This can free up time for other activities, such as research and analysis. Examples of using a stop loss. Fixed stop loss. A fixed stop loss is the most basic type of stop loss order. It is a predetermined price level that is set by the investor to close a position when the market reaches that level. For example, if an investor purchases a stock for $50 per share and sets a fixed stop loss at $45 per share, the position will be automatically closed when the stock price reaches $45. Trailing stop loss. A trailing stop loss is a more advanced type of stop loss order. It is designed to follow the market price and is set as a percentage or dollar amount away from the market price. For example, if an investor sets a trailing stop loss of 10% from the market price, and the stock price moves up, the stop loss level will also move up by 10%. If the stock price falls, the stop loss level will remain the same. This type of stop loss order allows investors to protect profits while still allowing the market to move in their favor. Guaranteed stop loss. A guaranteed stop loss is a type of stop loss that is used in volatile markets or during significant events such as economic releases. It is a fixed stop loss level that is guaranteed by the broker or trading platform, regardless of the market conditions. This type of stop loss is usually associated with a premium fee or a wider spread. On conclusion, a stop loss is a risk management tool that can protect your capital from significant market fluctuations. By setting a stop loss order, investors can limit their potential losses, take the emotion out of their decision-making process, and save time. There are several types of stop loss orders, including fixed stop loss, trailing stop loss, and guaranteed stop loss, which can be used in different market conditions and for different types of securities. Use code BLOG to receive 25% on your next purchase.